Joining me to review the market street is Justin Chukwu, is a licensed dealer and the group CEO at Carry Asset Management. Thanks for connecting as always. We appreciate your standing by for this conversation. 2 listings on the NGX this week, the NIDF and the VFD group. That's some good news, isn't it?
Yes, well, first of all, thank you, Bosin, for having me. It is good news because what is happening is that we're having the market deepen in terms of instruments that are listed on the exchange. With the listing of NIDF, that's Nigerian Infrastructure Debt Fund, which came at a capitalization upon listing at about 92 billion naira, and then listing of UFD group. Of course, the UFD group was listed at I think about 269 naira 30 kobo per share. So it then means that you're going to see more options available to investors. Investors, if you look at NIFD, that is basically an infrastructure fund. It's a debt fund, which means the yield or the return will be based, the dividend will be based on interest earned from disbursement of the fund for infrastructure purposes. And again, this infrastructure fund should also have an impact benefit in the economy because you're looking at addressing the infrastructure gap. So listing of additional new instruments, particularly from sector that previously were not listed, all add to the depth and breadth of the market. So it's good news for us and it's good news for investors.
Well, we also got today the new trading platform, which is a fintech platform for the Ghana, Nigeria, the Kenyan securities trading, which was unveiled today by Second Stack. How significant is this for investors and the market, in particular for broker-dealer organizations such as Carry Asset Management, in what is available for you right now to do on a big-time basis on behalf of clients and on behalf, perhaps, you're trading your own portfolio?
Yeah, Boston, it's a major landmark transformation or improvement on the exchange, given the fact that it's the first time we're having the integration of the exchanges in Africa. An investor can actually invest in instruments in Ghana and in Kenya now. So similarly, investors in Ghana and in Kenya, you must recognize that. You must recognize that the fact that African economies have largely been operating in silos. So you observe that inter-African trade is very weak. There is no integration in our financial system so that a Nigerian operator can actually do businesses in Ghana seamlessly like you have in other regions of the world. So this is going to be a major move by the economies in Africa to be integrated. So for me, it is something that is very cheering because it gives investors in these 3 countries at the first instance the options of investing in instruments in those other three economies. And I know that the plan is to expand it to include other African countries. But for a start, a Nigerian investor who is an institutional investor who could actually invest a minimum of 10 million naira could actually invest in instruments in Ghana and also invest in instruments in Kenya. So you can take advantage of changes in price levels in those areas. You can take advantage of returns in quoted companies in those countries. And it also helps you to broaden the risk, geographical risk you are taking in terms of your investment portfolio.
Interesting that this exchange, a common platform, will be in local currency. How will that work? What comfort does that give
there has to be a settlement process, which is why
Please go ahead.
There will be a settlement process, which is why second stars will come in. Because I think the platform they are providing will allow for that settlement. And the settlement, not just settlement in instrument, also settlement in payment. So there will be a settlement process that will allow for free exchange or easy exchange of transactions in terms of the multiple currencies involved in those 3 economies. So I don't think that should be a problem. Certainly there will be a settlement process, and the technological platform which is providing this will provide a settlement in conjunction with the 3 exchanges as well as the central banks of those countries.
Yes, but let's get on with the state of the market this week. We finished off just about 11 basis points. The market seemed to be one day in, one day out in terms of sentiment. So broadly speaking, in terms of sentiments, what's driving the market week, by the way, was just starting the month of October and the first month in the final quarter of the year?
Well, Boston, if you look at what, like you rightly said, it was a 1 day gain, the next day loss. So we had 2 days of gains and 2 days of losses this week. But the market still closed at a positive of 11%. 0.11%, 11 basis points. The sentiment driving the market are basically the macroeconomic environment. If you look at the macroeconomic environment, we're dealing with exchange rate issues, we're dealing with liquidity in the foreign exchange market, and then we also had some political attention, the distraction we had in the past this week. So I think, but the major propellers of what happened in the exchange, in the market, is that investors are now weighing their options, whether to go strong on equities or go strong on fixed income instruments. You may realize that most of the companies that the investors were expecting to pay interim dividend have all declared dividend. The ones that are supposed to declare, we expect to declare, have all declared. So in terms of benefit season, the mid-year benefit season is almost behind us. So investors that are looking for the immediate returns are not going strong on equities. So and that's why we've seen that fluctuation in interest in terms of investment, in terms of market direction. And we saw 2 days of gains and 2 days of losses. So, but basic thing that investors are now weighing their options and saying, can we really go into the fixed income space? Does it provide us a reasonable level of return? I know the institutional investors, some of them are winding down or slowing down in the level of aggressiveness in the acquisition of equities.
But interesting, so far this month, the DMO releases calendar for the last quarter of the year. You've got the savings bond, you've got the FGN bond, then you have the Sukuk of 150 billion that the debt office is also floating. So it looks like at the primary end, there's a lot of activities at the fixed income space. The equity is down roughly 30%. About 29.5% year to date. So do you think there's still a whole lot of headroom there, or investors should just say, look, it's been 29%. Inflation is about 24, 25, whatever. So maybe I should just net out by this time before December.
Yeah, if you look at it, the market has done about 29.6% at the close of business today, which is above the inflation rate of 25.8%. So ordinarily, you say on a basket, a full basket of equities instrument, an investor would have outperformed the
inflation level,
inflation rate, and there you actually have positively return on your investment. But remember that you're talking of a basket of the entire portfolio, entire stocks. And the reality is that nobody invests in a portfolio of entire stocks. But if you now want to take the individual instruments, you also observe that some of the instruments are trading at prices that are relatively above their intrinsic worth. There are some equities that are still gaining, but when you now just oppose the current market values and then look at the underlying operating environment and as well as the underlying performance of the companies, you find it difficult to justify the price that they are trading. Which is why I say that institutional investors, particularly the PFAs, are now more cautious in investing in some instruments. I would always recommend that people seek advice from experienced operators or market operators before you go into the market that's already at an elevated price level. Because at 29.55%, is clearly above the performance of the economy. The economy grew about 2.51% in the second quarter of this year. So far, the economy has grown about 2.41% if you add the 2.31% it grew in the first quarter of this year. And so if you consider the fact that the economy is growing at 2.41%, but the equity market has gained 29.66%, then you will agree with me that there may be some equity instruments that are relatively overpriced. And that's why we should not expect another gain of maybe 20% this year. Of course, if you look at the past one month, if you look at September, for instance, market actually lost about 25 basis points or 0.25%. This month, of course, they were done only 1 week this month. The market has gained 0.11%. But the summary of it is that the equity market seems to have gotten to a point where you may say it at the point of resistance level. So investors may not be so aggressive in bidding up prices materially above where they are today.
On a balance of 1 to 10, what's worrying investors the most right now about the state of is it the political environment, about the state of the economy?
I think the most important thing worrying investors is the state of the economy. Like I did say, the economy is struggling at 2.51% growth, and we also not sure, given the collapse in consumer demand as a result of increase in price levels, that the economy will even grow at the same rate that it grew in the second quarter of this year. So investors are worried about the general outlook of the economy. And like I also said, if there is a divergence between the performance of equity instruments prices and the economy, then you should be worried unless you can pinpoint to a sector like the banking industry that are enjoying some headwinds, some tailwinds in terms of their performance. So if you exclude industries like the banking industry, you have to be very circumspect in bidding up stock prices that are already elevated.
So we're heading toward the period of the year with a lot of festivities. So if you look at Nigerian breweries saying it's going to issue notice of price increases to some of its products, then Guinness Nigeria says it stops selling some of Diageo's products in Nigeria. How do you think this will impact investors' sentiment, or do you think folks will just drink on and say, well, just put it behind us?
Guinness own is particularly different because some of its premium brands is going to relinquish selling them from, I think, from April next year, 2024. But in terms of this year, we still get the benefit of selling those premium products that Diageo wants to now directly market in the country. But what has happened is that in the brewery industry for the first time is suffering, feeling the impact of collapse of consumer demand. Previously, we used to say that when the economy is bad, people drink more, and when the economy is good, people drink more. So whatever is the direction of the economy, people want to hit the bottom.
Is that changing?
Like so. With the relation in...
Is that changing?
Pardon?
That seems to be changing, is it?
Yes.
Yeah, because if because if the economy is not performing, you need money to drink away the bad economy. But if the economy does not give you money, what do you spend to drink it away? Okay.
Yeah, the basic thing, like you rightly said, what used to happen is that when the economy is bad, people drink away their sorrows. When the economy is good, they celebrate the good things. But now, the economy has gone so bad that people are now counting their pennies to determine how to adjust their household consumption and focus on only the priority consumption or critically important consumption. So the breweries are clearly also be feeling the pinch of the current economic environment. In terms of as we're approaching the Yuletide, where the merriment and celebrations, it's going to be, if I'm to project, I think this year is going to be slightly more difficult because if you look at the group of people that go home most of the time, the people from the eastern part of the country, particularly of Igbo extraction, the transport cost of commuting, taking a whole family from Lagos to the east, this amount is going to break the back of many average households. So you may not see that level of homegoing this year, and which simply means that the economy is really biting hard in terms of household consumption.
Interesting. So what will likely happen if guys are not traveling? Perhaps they could spend a bit of that, taking some products from the brewery sector, at least in Lagos, at least celebrate with friends. But whatever, I'm sure the transport sector will feel a bit of that if folks don't travel as much. So you've got to, it's all going to have some impact one way or the other. But let's leave it there for tonight. Thank you so much. You got to relax and enjoy the weekend. We appreciate the deep dive into the market for us as always. Have a great weekend. Johnson Chukwu, the CEO at Carry Asset Management. Thank you so much for your time.